What's going on, everybody?
Hey, how are you?
I am well. Terrell Patton, to what do I owe this pleasure? You're muted, buddy, but looking good as always.
Hey, you catching me fresh out the gates, man. I'm back. I've been down for a couple of months, but I am back, bro. I'm back
Nice.
ready. And I saw this pop up on my calendar, and I'm like, the agents need it. They want it. I don't want to hog up anything, but I sent out a text message to my agents, and just said, what are you struggling with right now? Hey, I want to support you. What are you struggling with? And they say they don't know what the market is doing. Their clients don't know. They don't know what to tell their clients when their clients are asking them. They're confused. And this popped up, dude. I was like, oh, this is crazy. So
There you go.
that's why
Good. Well, yeah, so what we'll do is we'll jump into some national stuff first. I kind of switched up the way, so we get the national stuff out of the way, so that way those of you that aren't in Central Ohio don't have to stick around, and then we'll roll into Central Ohio specific stuff. Obviously, you're welcome to if you just want to know what's going on in the Columbus market, but definitely we'll hit up the national stuff first. So anybody else have any specific questions or anything that you for sure want to learn about to make sure that we hit it? No? And you guys can feel free to use the chat too. And then whichever brave souls, those of you that don't mind interrupting me, just unmute yourself and tell me I missed something in the chat if I do. So there's enough of you on here that don't have any problem calling me out. So definitely feel free. All right, I'm going to go ahead and share and we'll get rolling. Got a lot of good stuff here. So lots going on. All right, so we will play the slide deck here too. All right, cool. All right, so a little bit about me. I think most of you on the call know who I am, but I've been an agent since 04. So I had the distinct pleasure of going through 2008 to 12. So this isn't my first shift by any means. I do run the Marsh Home Group. We are looking to add agents. So that's my shameless plug of the day, my first and only. I'm also a real estate investor. We own 15 properties in our investment portfolio, both Airbnbs. We have 3 Airbnbs, and then also 12 single family / duplexes. So that's where we're at. You can follow me. I do periodic market updates throughout the month, usually in my stories on Instagram, which also flow into Facebook if you just love what you see. So feel free to follow me on those if you're not already. What are we talking about today? Well, first of all, like I said, feel free to interrupt me if you guys have questions. I love for this to be interactive, but I can also, for those of you that know me well, I can also talk to myself for 30, 60, 90 minutes, however long you guys are willing to sit here and listen. My intention is probably closer to 30 to 40 minutes today, but definitely happy to answer questions. So we're going to look at inventory and selling trends nationally, take a little bit deeper dive than normal into interest rates, and then also talk about how inflation is impacting rates and why I think in the next couple months, we're going to see some changes with regards to the direction of rates based on inflation data. And then we're going to talk a little bit about, so Terrell, to your point, I think just like anything, there are a billion different things that you could talk about with clients to make yourself feel and make them feel like you know what you're talking about. But my encouragement would be to pick 1 or 2 things that really are the most applicable. And I think interest rates, the data has shown it, and both, as well as my experience and probably many of you on this call, the interest rates are really the thing that drives is driving a lot of fear and uncertainty in the real estate market. And the data has kind of proved that out the last few months as we've seen these major fluctuations. So we'll talk about some of those kind of key talking points, and then we'll dive into Central Ohio stuff. So for those of you that are on the call from other parts of the country, you don't have to listen to it unless you want to. So, all right, so let's jump right in. So first things first, active listings. So remember, data is always about a month behind when it comes to the national stuff. So I get this realtor.com data usually comes out like early March for February. So it's relatively timely when it does. But obviously now we're starting to get to this data being a little bit stale. Active listings are down, as you can see, month over month, but up still 67.8%. So the reason that they're down is frankly not because of increased buyer demand. It's lower new listings, as we'll get to in a second. So pending sales are up, which we would expect that to be. You kind of look at past years. If we saw pending sales down, we would really be in trouble. We are below kind of 2021 and 22. But as you can see, pending sales wise, we are still up above pre-pandemic. So that's something that I think a lot of people just have they really have a hard time grasping, because we have had 3 years of a pretty crazy market, but really pre-pandemic things were not as good as our short memories think that they were. So I think it's definitely a very different environment than it's been the last couple of years. And for a lot of agents that haven't been in the business for over a couple of years, or those of us, all of us probably, that have short memories, it feels very slow because things have slowed down so much. But this is always an interesting number to me. The fact that pending listings are still higher than they were in 17, 18, 19 is a little bit of check on reality there. Newly listed homes, this is the biggest reason why. I mean, Terrell, I don't know, or any of you that are on the call from other areas, I know here in Columbus, we definitely don't have a lack of buyer demand, but we really just don't have any houses to sell them. So even though the active count is up, it's still really low. And a lot of those new actives, as we'll get into, because I don't have this data on the national front, but locally, when you look at the new construction is making up a much larger percentage of the newly listed homes than it was last year, because the builders finally need us again, because their houses maybe weren't selling as quickly as they were last year. And so the number of resale homes is just way low. And we, if we continue on this trend, I think that we'll continue to see pretty strong pricing, either stabilization or even increases, just because it's a supply and demand equation. It's pretty simple. So the biggest driver behind the lack of new listings is absolutely interest rates. Sellers just aren't willing to, I have it over here, just not willing to sell their 3% to buy 7%. That's just the reality of it. Something in the range of 70 to 80% of sellers are also buyers. And so because of the equity positions that people have, a lot of people are out looking to buy, and they have a house to sell, but since they're not finding what they're buying, what they want to buy, then they're not selling. So it's kind of the chicken before the egg conversation, but it's true across the board, not just in our local market. We look at days on market, we were trending up basically since last June or July. Let's look, actually, if we look at 2023, the pink line, or 2022, the yellow line, since really May technically, but certainly in June to July was the biggest increase here in days on market, and kind of increased pretty significantly. And then now we're back on a pretty steep downward trajectory. So I would not be surprised if we see these days on market start to dip and kind of ride alongside 2021, assuming inventory stays as low as it is. Median list price. So I drew these on here, and the list price is a little bit different. Well, for those of you, all of you, for the most part, are agents. So you guys understand, just because you list a property at a certain price doesn't mean it's going to sell here. But the concept is still the same. We don't have, I don't have, unfortunately, a good chart for sold prices. But what I drew on here were the prices from last year. And basically, one of the things that we're looking at with inflation is that we want to see, well, we don't want to see it for our clients, but from an inflation perspective, we want to see the year over year prices either go even or maybe even negative, because that's going to push inflation down. So right now you can see that we are still price wise above last year in February, the difference between these two. March was just a little bit higher. And so if we were to see any kind of downturn, that would happen, but we'd need to see price growth happening in order to, which it did from January to February, but we would need to see that trend continue in order to not be negative year over year in April. So this is something that we have our eye on. The sold data is actually a lot. I mean, when I say a lot, it's in quotes, but worse than this, sold data was only up 1.3% in January year over year. So I think that what we're going to see either this month or next month is that we're going to go negative, and that's going to be a positive thing for inflation and also for interest rates. And I'll get into that in a little bit. Price reductions. Actually, I don't think I updated my verbiage on here, but actually price reductions were down. They're up 7.6 year over year, but definitely trending down in February. So I did update it. They are trending down in February compared to January. And I think really overall, that is just a sign that sellers are getting more realistic about their list price and not pricing on such an upward trajectory like we had been for the last couple of years, and or agents are better educating their clients to make sure that we're not overpricing, because they know that the overpriced houses sit on the market. The ones that are priced correctly, at least in our market, are still selling with multiple offers. But if you miss the market, you may be sitting for a little bit. So, but the lack of price reductions could also be another sign that pricing is either at or near a bottom, or maybe has already passed the bottom. So we'll continue to keep an eye on that. So Terrell, I know you're on here for the South. This was some interesting stuff for me. So obviously the South and the West have been leading the charge with regards to real estate in terms of pricing and inventory and all kinds of other things. And this is a regional comparison. And obviously, since we are here in the Midwest, I thought it was really interesting to see the Midwest leading the year over year appreciation, which is not something that we typically rank first in, but even price per square foot. And then we're also in the top 2 with regards to days on market. I've found it interesting throughout this downturn that the Northeast has stayed pretty strong as well. So it'll be interesting to see if this is just kind of a blip in the radar, if there's some kind of trend. I can't imagine that people have started to like cold weather over warm. So Terrell, I'm sure you'll be back on top here soon enough. But overall, irregardless of what's happened in the last 12 months, this is the number that I think we should be focusing on when we're talking about the strength of the market. We're seeing anywhere from, it's actually a pretty tight range, between 32.7% and 36.9% of median listing price versus pre-pandemic. And so what that says to me is that the average person that bought their house before 2020 has about 35 to 36% equity, probably on average. And that's a really good place to be from a market strength perspective. And what I mean by that is, you know, in 2004, 5, 6, 7, we had a lot of people that had bought with 0 down. nationally, we weren't experiencing massive appreciation during those years. They were decent appreciating years, but really starting even in 2006, the writing started to be on the wall that the party was over. Lending was starting to tighten up, and people just didn't have the equity. And also, not to go too deep into the 2008 thing, but we were also in a situation where a lot of people were on adjustable rate mortgages. Like, for example, a 5/1 adjustable rate mortgage or a 5/1 ARM was a lot less expensive on an interest rate than a 30-year fix. So a lot of people had moved into those adjustable rates. And then there were also a lot of the people that did 0 down loans. For those of you that weren't in the business back then, they actually didn't do one big mortgage like almost all buyers do now. It was a first mortgage and a second mortgage. And the second mortgage was almost always 2-year fixed. Sometimes if it was a subprime loan, all of it was 2 years in many cases. And so the concept was, and you can see how flawed it was that usually you were subprime because your credit wasn't as good. You were going to buy a house and then you were going to fix your credit, which is funny that you didn't own a house and didn't have all those things to buy and spend your money on, and you couldn't have good credit. But by buying a house and needing furniture and all these other things, somehow magically that was going to fix your credit score. But a lot of people were on those adjustable rates. So as soon as rates started going up like they have here over the last year, you can see how people that didn't have a lot of equity or no equity quickly were in trouble, because after rates rose, then quickly following that, values started going down just a little bit. And then we had a huge recession with a lot of job loss. And so now you're in a situation where you have no equity. You live in a house. Your house is not worth as much as you paid for it, and now you have no job. So your only option is short sale foreclosure. And then it was just a downward spiral from there. So I say all of that for those of you that weren't in the business, because being able to explain what was different then than now is a really major thing. The other thing is that just in general, typically housing prices do not go down during recessions. They obviously did during 2008, but it's not a normal thing. And the last thing I'll say about that with regards to pricing is that pricing, we are in what's causing the slowdown right now is high inflation. And that's largely been driven by people having savings, because during COVID, they weren't doing as much. But then also following COVID, we've seen a lot of wage growth. And so now people are making more money than they were before. And for the most part, people have 30-year fixed mortgages. So their housing costs are not increasing. Now, obviously, everything else is increasing. But we're in an environment where we would expect to see all goods and services continue to inflate in value, and housing is not just going to be sitting on the sidelines being the only commodity that's decreasing in price. Now, it could have decreased over the last 12 months, for example, but in terms of the grand scheme of things, it's a very small percentage of the number of homes in your community or area that would have seen their value go down below what they paid for it. And on top of that, most people were putting down a significant amount of money on most properties. So interest rates, I mean, really, is there anything else to talk about at the end of the day? After increasing for most of February, rates have been dropping for about the last 10 days. They're up a tiny bit today. I think we'll see pretty much relatively flat rates, if I had to guess, unless there's like another bank that fails or something like that. I think we'll probably see flat rates through the Fed announcement on Wednesday. But I think there's still going to be a lot of uncertainty probably over the next 30 to 60 days with regards to what the Fed's going to do, and also inflation, because the numbers are still going to probably be high for at least one more inflation reading. So what our hope is that rates kind of stabilize, because what we know is when rates stabilized for this period here in January, December and January, we saw the market start to recover. And then you see in February, they just went back up again, up to over 7%. And then we saw things start to slow down again. And people, the lack of certainty when they got pre-approved at 6.25, and now their payment, now they're looking at their payment at 7, and they're just like, I can't do it, or I don't want to do it, or what happens if blah, blah, blah. And the house hasn't gotten any better. In many cases, the house has gotten more expensive. So I'm not, as I put here, the last thing I'll say about the Fed meeting, we're not as concerned whether they raise or lower rates. It's not going to have a huge impact on probably the rates itself. What's going to be more important is their language, what they say about the economy, and whether they feel like the economy is going into recession or not, whether they feel like inflation is their inflation fight is working. That's going to probably dictate what happens with mortgage rates more than anything. Because remember, what the Fed raises or lowers is not the same as mortgage rates. Those are short-term rates. We tend to follow the same pattern, but you could see the Fed raise rates a 1/4 point, 25 basis points on Wednesday, and see mortgage rates drop depending on what they say. So I know that's super confusing, but be on the lookout for that. One thing that we've seen is VA and FHA rates remain lower. I also think in May, there's going to be some things changing with conventional mortgages that make it more likely that conventional mortgages are going to be more expensive for many buyers, more expensive than they are today. And FHA just lowered their mortgage insurance premium starting, I think, sometime this month, I believe, for new case numbers issued this month. And so we're going to continue. I think that especially in areas where demand or where the market has slowed the most, you're probably going to see a much larger percentage of new contracts coming over with either FHA or VA rates. Obviously, we've, when I got into the business in 2004, really the United States hadn't been in any meaningful, we were in, what was it, Desert Storm, I think it was called, in the early 90s, but it was pretty short-lived. But other than that, it had been Vietnam. And so the number of veterans that were buying and selling homes was not nearly as many as it is today, having just gone through almost a 20-year period where we were in constant war of some kind, whether it was Afghanistan or Iraq. And so we have a lot of veterans out there right now. I'm sure you guys are all seeing the same thing. And so I think a lot of them have not been able to take advantage of the VA benefit because of the fact that the market's been so crazy and it's been conventional all the way. You're going to start to see, because the rates are a lot better, it's 0 down, there's no mortgage insurance. And then even with FHA, the rates are better. And with the mortgage insurance premiums dropping, it's going to drop monthly payments compared to what they were even right now. You're going to start to see more contracts with government lending. This is just a quick idea of the difference between mortgage payments at the beginning of last year and mortgage payments now. We're probably closer to 6.5%. I was hopeful when I left this on here at 6.25 that we would go down today, but we're probably closer to 6.5, 6.25 to 6.5. But yeah, it's real money for people. And obviously with the cost of everything else going up, I would say this is another thing to just let people know. It's real money. So if you're going to do one thing with regards to interest rates, I would recommend downloading the app mortgagenewsdaily.com. So all of these slides that I put on here that we just went through, they all came from mortgagenewsdaily.com. And you don't have to dig this deep into it at all. If you put the app on your phone and allow push notifications, they will send you every day whether rates went up or down. There's all kinds of other information if you want to geek out, nerd out. If you're a data nerd like me, you can dig into it, and it's a lot of really good stuff. But if you're like Troy, like the reason I come on this call once a month is just because I don't care about it, but I know I need to know it. If that's you, just download the app, and every day it's going to tell you, did rates go up or did rates go down? And you're just going to be able to use that as another tool in your tool belt to keep your clients informed about what's going on. If rates go down a lot today, it's worth reaching out to your client and saying, hey, did you lock in your rate with your lender? Or if the perfect house comes on the market and they're hawing, hey, did you check with your lender on this? Because your payment might be lower than what you thought it was because rates just went down yesterday. Those types of things. The last thing on interest rates, though, as much as they have driven the market up to this point, I do think that there are a lot of sellers out there that have put off moves that are either necessary or highly desirable because of interest rates. And at some point, they're going to reach the place where it's like, whether it's death, divorce, disease, or diapers, at the end of the day, life goes on, whether interest rates are 3% or 6%. And I read an article a couple months ago that said the average American has about a 1-year memory. And we're now entering that time. If we go back to this slide here, we were not below 4% a year ago. So now our gap, if we can get this down to 6% or even 5.5%, we're within a 1.5% gap instead of a 4% gap like we were a few months ago in October when they spiked up. And I think if we can get into that 5.5% to 6%, maybe even 6.25% range, and kind of sit there, that we're going to see a lot more sellers being willing to put their house on the market and just bite the bullet, because life has gone on and things happen, and you're only going to hold off your life for so long if you can afford the payment. And frankly, a lot of people got raises and have gotten raises and are making more money. And maybe they're spending it on things that they don't need to. So, all right, this is the big thing I haven't talked about. For those of you that are in my office here in Columbus, I talked about it briefly at the office meeting last week. But CPI stands for Consumer Pricing Index, and it's basically what the Fed uses to decide whether they're going to raise rates. It's a big part. It's not the only part, but it's a big part to whether they're going to raise rates, lower rates, keep things the same. They want to see inflation be around 2% year over year. Right now, it's at about 6% year over year. But as you can see here, what makes up the CPI index is the biggest one is housing at 34%. Okay, so that goes average rent and then also year over year purchase prices, and they look at year over year. And what we see here is through January, we had been at the beginning of last year, we were year over year nationally up 15% in median home sale price, which is insane, right? And so we saw that through a lot of last year. So when they go in and look at the consumer pricing index in this month, 34% of it is going up by 15%, to put it into simple math. So in order for the number to be lower than 15%, everything else has to be quite a bit lower than 15%, because this is the largest piece of that pie. But you can see in January, it was only up 1.3%. And like I said, as we move into the February data, actually should be coming out any day now. And then as we move into March, for sure, I think we're probably going to see that go negative. And so we're very likely, even with other prices having gone up, I think we're very likely to start to see inflation come down significantly in the next couple months. There's a guy named Barry Habib who is with, what's the company is he with? Man, if I think of it, I'll let you know. But either way, his prediction is the May 10th CPI is going to be very, very good. meaning it's going to be a lot lower than it's been up to this point. So even if we have no more bank collapses or anything like that, which would push it down even further, most likely, but even if none of that stuff happens, we anticipate a lot more stability beginning in May. And it's almost, I mean, nothing's guaranteed, but the data is going to get a lot better. And so we expect to see some stability happening over the next 30 to 60 days when it comes to interest rates. Obviously, housing prices isn't the only thing that goes into housing or sales prices. Also, rent is factored in. And you can see this is coming from Zumper. This is a 1-bedroom year over year. But you can see during the pandemic, after kind of being pretty stable, and actually rents had gone down in October of 2019 or the summer of 2019 year over year. Then during the pandemic just skyrocketed in terms of year over year changes. And then you can see the consumer pricing index increase accordingly. So now you can see rents are coming back down in terms of year over year increases. And so we would anticipate that that'll impact CPI. And then this is just another way to look at it. These are 1 and 2 bedrooms. From last year to this year, we're seeing rent year over year increases going down. And then this is the big key. If you look down here, the 1-bedroom rentals remained unchanged from January to February, and 2 bedrooms only increased 0.1%. So from month to month, we're not seeing hardly any increases. So that, again, all good news for that. So ultimately, what we want is for you to pick 1 or 2 of these things that you can be able to regurgitate to your clients. I'm more than happy, for those of you that haven't been on this call before, to send you these slides so that you can share them with your clients. You can reread them. We will also be sharing the recording of this. So if you want to go back and rewatch it, or if you want to email me and say, what the heck were you talking about? Happy to give you a little bit of additional understanding. So financials, also with mortgage data, understand financing. I mean, I think a lot of clients are really anxious because they don't get financing, and that's a big deal. So yeah, Sarah, let me go ahead and put my email in here. If you guys could send me an email and request those, then I'll have Allison get that stuff to me, or get that stuff to you, sorry. In general, again, this is opinion, and really it hasn't changed much. I think if you're in a growing city and you have low inventory, which are the majority of cities, you'll probably continue to see lower than normal days on market. Again, I'm not saying lower than 2022 and 21, but I'm saying lower than normal when we go back and look at 17, 18, and 19. We have seen the number of builder listings on the MLS impact the number of pendings and also the days on market. So just be cognizant of that depending on where you're getting your data for your local market. And then again, as I mentioned, the target interest rates from some data and things that I've listened to from like housingwire.com and some of those other things, it sounds like anywhere between 5.5% and 5.75% 30-year fixed rates seem to be a really big trigger for buyers, meaning they seem to really get off the fence at that point. So I would absolutely anticipate that if we see rates go down into that range, that you're going to see a much stronger spring and summer market than maybe some of you think. But we will see. But I would use, if you're in a market where you're not seeing multiple offers, I would use some of this data and some of what I would call positive data for the next couple of months as motivation for some of those buyers that may be sitting on the sidelines thinking that things are going to get worse before they get better. All of the data is pointing to things getting better, and really, frankly, already have gotten better. And I expect that you'll continue to see that happen, even if you haven't seen it in a major way in your market. I know here in Columbus, we are definitely seeing a lot of multiple offer situations and a lot of over list price happening again. And I suspect that a lot of you will start to see that, assuming that the inventory levels stay where they're at. I would also, and I had it on one of those previous slides, but really encourage you to talk to your lenders and allow them to educate you on the different types of loan programs out there. It is mortgagenewsdaily.com. And educate yourself on the different loan programs out there, and be able to tell your clients how they can use a bridge loan or how they can use a home equity line of credit to leverage the equity in their current home to be able to go start looking and actually buy a home without selling their current home if they can qualify for it. A lot of buyers and sellers just don't understand financing. They've always done it one way, and they don't know how to do it the other way. And so that's your opportunity to create value. So yeah, so hopefully that was helpful. Any questions for any of you that aren't in Central Ohio before I jump into the Central Ohio market? Feel free to unmute yourself, or I'll check the chat here real quick.
No, man, I just want to say great stuff. I appreciate you. It's given me some good ideas, and definitely the resources were amazing. Thanks so much.
Cool. Yeah, and all of that realtor.com data too. It's just on the website. So
Yep,
you can always pull that. You guys could pull it for your office meetings, but
Yep.
I'll send you the slide if you want to slides. If you guys want to post that in your groups or whatever, you're more than welcome to.
Awesome, man. Thanks again, Troy. I'm
Cool.
out. Thank you.
All right. See you, bud. All right. Anybody else have any specific questions? Was that too in-depth or okay? Let me know in the chat if I got too deep into it.
Not at all. That was good.
Okay, cool. All right. Well, I'm going to jump into to Columbus here next. So, all right. So looking at February, we were up in inventory by about 30%. These are all resale and new construction. Down in new listings about 10%. Down in solds 15%. And then pendings, though, were up 7.6%. So again, I think at one point, maybe in December, we were about minus 25 or 30 in terms of year over year solds. And we're starting to chip away at that, obviously, with the increased number of pendings. But the new listings is absolutely the story of the year so far. In terms of last year, we weren't getting that many new listings. And this year we're getting 10% below that. And so that's helping offset the definitely lower buyer demand. So, and remember, the buyer demand is coming with the listings, right? 70 to 80% of sellers are also buyers. So as soon as you take away 10% of the sellers, you're taking away 7 to 8% of the buyers just automatically. So you can see how kind of they go hand in hand with each other. Now, one of the things that I'm going to start doing, because it's getting significant, is separating new construction and resale. Because as you can see, the number of properties for sale on the MLS that are new construction are 62.9%, up 62.9%. Okay, so that's a pretty significant number. The new listings for the first 18 days of March is down 38%. But if we look at February over February, we were up about 11% in terms of new listings for new construction. And then we were down 11.6% in terms of new listings for resale. Solds for new construction, again, these are all just MLS numbers though, right? So we don't have the complete numbers. I don't know that there's a really great way to track that locally, at least. I think NAR comes out with that stat, but that's nationally on new construction versus resale total numbers. But yeah, we're definitely seeing pendings up in February compared to January, which is good. That's what we should be anticipating. We would expect we'd have more listings in February than January, but this is the number that we're keeping an eye on. The active number of properties is down from January to February, which is crazy. I mean, in a normal year, the number of actives should definitely be going up. It did went down last year too. But that's definitely a sign that we're in for a tight inventory in the spring for sure. So again, this is resale only. Year to date, new listings are down 16% compared to last year. So definitely that's our source of trouble for sure. I think we'll continue to see that. Days on market appears to have peaked in January. Again, I took out the new builds and you'll see why in a second. But 97% original list price to sales price. I do think that as we start to get through the data, again, that's up from last month, as we start to get some of the solds from after the first of the year closing, we'll probably see that 97% continue to tick up. And I anticipate that we'll continue to see the days on market going back down. So months of supply resale wise, we're back below 1 month, which is crazy considering a balanced market is 4 to 6 months of inventory. But new construction is at 3.1 months. Now, obviously, a big reason for that is that they list the properties 6 months before they're going to be completed. But just keep in mind that inventory data can get skewed pretty heavily if you include new construction in that. I talked about this before in terms of year over year. I did think that even in Central Ohio, we were probably going to see year over year numbers eventually go negative. We might still see that, but the trend of pricing from January to February says we may not. I mean, this is pretty in line. Actually, it's a much greater increase than last year. This was January to February last year, or February over February was up 3.8%. I guess I don't have January 22 to February 22, but we were up 5.6% in terms of average sales price. We don't track median, unfortunately, but yeah, so we're still going to be appreciating year over year as of now. So we'll continue to keep an eye on that. I do think we might see some buyer and seller freak out when the news is talking about the prices year over year decreasing. So just be prepared for that to make sure that they understand that things are on the upward trajectory again. And again, when we talk about averages, remember, if there was a really expensive house that sold, it's going to impact that in a way that it wouldn't with median. If we think all the way back to 5th or 6th grade math, the average is all of the properties, total volume divided by the number of properties that sold. And the median is the one right in the middle. So an equal number sold for less and an equal number sold for more. And so that tends to be a little bit more of an accurate number. But you can see some of those really expensive land deals that have posted in the MLS recently have and really expensive houses. I mean, I ran across one $3.5 million house yesterday that went into contract, I think in 15 days or something like that. So the higher end is moving in a way that it really hasn't here in Central Ohio in the past. So we'll continue to see if that's a trend. So anyways, sources, Mortgage News Daily, Realtor.com. And then for those of you that are in our Columbus office, we have trendgraphics.com available to you, which is where I get the majority of that data that I just went through. So That's all I got today. Any other questions from anybody? I appreciate you guys sticking with me here. Anybody have anything that I talked about that doesn't make sense, or maybe some experiences that you've had that are different from that? No? All right. Well, if that's a great question, Emily. Let's get that out to the group here. Who's your go-to lender for creative products in Columbus? When you say creative, what does that mean? Like bridge loans and stuff, or does that mean like how creative are we asking?
Hey guys, just anything you have. I mean, I put in the chat just now, like I've had some recent success with NFM and home side, but just curious if, there's so many lenders out there, they're all calling us for meetings. Who have you been meeting with that you've been pleased with or worked with, and what are they offering? Maybe I don't even know about it.
Yeah, no, that's good. Well, I'll throw mine out and then, well, actually, does anybody else have anything? If anybody has to go, I'd love to hear. Anybody have a lender that they're super excited about? It's done anything unique? No? Okay. Well, I'll say, so I've been impressed recently with Noah Brader from Union Home Mortgage. He has some pretty, I wouldn't say that they're super unique products, but he's a little bit more aggressive specifically on bridge loans and a couple other things, and he's just very much on top of kind of what's happening in the industry, and he keeps, like, he sends out a slide dial every week just to say this is what's going on, which I find extremely helpful. I work a decent amount with Anthony Leahy. He's a mortgage broker, so he can get into some unique products about specifically around like DSCR loans for investors, and then also some like bank if people have like are self-employed and they don't have the income on their tax returns, he can do like some bank statement loans and different things like that. The problem with a lot of those exotic products, to be honest with you, is just that they're so expensive on the rate side that unless somebody just has a ton of cash and had a really bad year in their business or something, like they're not really great unless it's a really unique situation. But I would say Anthony Leahy is like my guy that I go to if I have somebody that I need unique financing for. And NFM, I mean, I've used David Orocho at NFM for years and years. And he's always been awesome. So I think you don't go wrong there for the most part. In terms of overcoming hesitancy of the seller. So my comment on hesitancy of the seller to give up the rate is that really, I think a lot of people over the last 3 to 5 years have moved out of convenience instead of necessity. And when you enter a shift, there's just going to be fewer people that move. When people have fear, they tend to do nothing. The safest thing is to do nothing, right? On the other side of doing something is some unknown. And so everyone's natural tendency in an environment where it's not consistent and where there's a lot of uncertainty is to do nothing. So I think no one has a magic pill on the 3% versus 7%. I think your magic pill there, and it's not one that you're going to want, is you just have to talk to more people and find the people that need to move instead of just the people that want to move. Because when they just want to move, that's when the interest rate can really impact their decision making. When they need to move, the interest rate doesn't matter. So again, it's the 4 Ds, right? Death, divorce, disease, and diapers. So go and find a probate attorney, go and find a divorce attorney, go and look for people who have had 3 kids during the pandemic. You know, those types of situations where the rate is going to be a hit, but it's not as painful as having 3 under 3 in your house that's 1,200 square feet. Obviously, if someone passed away, they need to sell. If they're divorced, they probably have a lot of motivation to get their house sold. So I think those are good. When we're talking about buyers, though, what I will say is if they're very motivated to do something in the relative short term, I would also say prices are not going down. And interest rates can always be refinanced. So as long as they can afford to move now, even if they don't want to move now, most likely the cost of moving now is going to be less than it is once rates come down. Because I think that as soon, the market here in Columbus is crazy already, but if we're at anywhere near this level of inventory and rates come back down, like I said, to 5 or 5.5, or maybe even 5.75, you're going to see a frenzy, maybe unlike anything that we've seen in the past, which is crazy to say out loud. But what's already happening at 6.5 to 7% rates right now in this market is any indication of what could happen if rates go down and all of a sudden a $600,000 house, the person that's buying a $450,000 house today can buy. I mean, if we go back, and for those of you that need to jump off, I completely understand. But if we go back to this right here, and I just lost you guys, went behind my, I'll share my screen again really quick. If we go back to this slide right here and look at what the difference is with regards to your payment, and say that, you know, somebody at a 6.5% rate could buy themselves an extra $100,000, for example, in value by the rates reducing. Now that same buyer has been looking at a $500,000 house, and now all of a sudden they can buy a $600,000 house for almost the same price. So what do you think they're going to be willing to do in order to get the $550,000 house, when last week or 2 weeks ago they were okay with this $3,000 payment for a $500,000 house? Now if they can get $550,000 for the same payment, they're going to be all over that $550,000. And they're going to be like, they're going to feel like they won the lottery because they got a much better house. So I think that what we're going to see is I think it's a matter of when, but when interest rates go down to a place where it's going to open up buying power, you're going to see a frenzy. And the people that, you know, didn't buy now because they were scared that prices might dip a little bit in the very short term are going to really wish, just like last year. I mean, just like last year when people didn't buy because they were so worried about this like tiny window or overpaying by $5,000, and then 6 months later they spent $60,000 more to get the same house. So all right, anybody else? No? All right. Well, you guys have an awesome day, awesome week. Enjoy the sunshine. Thank you
Thanks,
as
Troy.
always
Thank
for
you.
jumping on. Krista, how are you?
I'm great. Thank you for asking.
Good. Awesome.
Troy.
Well, thanks for participating, and look forward to it next month. See you guys.
Thanks, Troy.